Coming up on Market to Market, governors tour Midwestern packing plant and vouch for the safety of U.S. beef. The Agriculture Department releases its much-anticipated prospective planting estimates. And despite political rhetoric, analysis reveals little correlation between U.S. oil production and prices at the pump. Those stories and market analysis with Alan Brugler next.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.
This is the Friday, March 30 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. Wall Street wrapped up its best quarter in 14 years Friday, as mounting evidence indicates consumers are becoming more confident in the U.S. economy. The Dow Jones Industrial Average logged an 8% gain in the first 3 months of 2012, while the S&P 500 moved 12% higher. Both figures reflect the indice's best first quarter since 1998. The tech-heavy NASDAQ recorded its best start in more than 2 decades, and the rally fires were stoked in part by a rapidly improving labor market. The economy added an average of 245,000 jobs per month from December through February, pushing the U.S. unemployment rate down to 8.3%, nearly a full point lower than last summer. And the Consumer Confidence Index held nearly steady in March after February's figure was revised to a 12-month high. Consumers do appear to be gaining confidence in the U.S. economy, but another development in the first quarter prompted some to question the safety of ground beef. This week, a group of farm state governors adamantly refuted those concerns.
And as members of the media, you owe it to the consumers to report the facts. Let's call this product what it is, and let pink slime become a term of the past.
Beef state governors, meat industry representatives, food safety hawks, and a media horde descended on northeast Nebraska this week. The hastily planned tour of beef products South Sioux City plant came amidst a public relations nightmare over a product known within the industry as finely textured beef. But its more dubious name, and one frequently cited by media, pink slime, has garnered substantial traction in televised reports and social networking. Republican governors Terry Branstad of Iowa, Rick Perry of Texas, and Sam Brownback of Kansas launched an all-out media pushback during their visit and seized the opportunity to explain and defend finely textured beef. Craig Lech, BPI's Director of Quality Assurance, explained the process of treating raw and processed beef with ammonium hydroxide to kill bacteria.
The fact is that ammonium hydroxide has been used in food processing since 1974. It is FDA approved, USDA approved, and is in hundreds and hundreds, if not thousands of food products across the country. If the potential of a microbiological hazard is there, such as E. coli 0157H7, we know that this is an extremely effective tool to eliminate, if not reduce that completely.
Other industry representatives argued the process of mixing previously leftover beef cuts into ground meat creates a healthier, leaner product for consumers.
You and I are old enough to remember you went to the store and you could find regular ground beef and maybe something like lean ground beef. I mean, now look what we have, 96% lean. They're all different types of ground beef that are produced now because we have the options to mix this together.
But a message of leaner, albeit highly processed beef has yet to break through mainstream coverage of the industry-wide uproar. Janet Riley, a spokeswoman for the American Meat Institute, pinpointed one image in particular.
There's an unfortunate picture that's floating around that looks like strawberry yogurt. That is not lean, finely textured beef. And we've tried to tell people individually to stop using that photo. We finally put out a nationwide statement and put words right over the photo saying this is not lean, finely textured beef.
An intense social media backlash against finely textured beef has sent grocery stores scrambling to take the product off shelves, while BPI fights for the survival of more than 600 jobs at plants on temporary shutdown. The potential economic impact is just beginning to take shape. Under substantial consumer pressure, USDA will begin offering school lunches next year without finely textured beef at a higher price per pound. USDA will still offer 95% lean beef that includes the finely textured product. Earlier this week, Agriculture Secretary Tom Vilsack defended the safety of the product.
But we hope that as this choice is being made, that it's based on the facts, that this product is safe, this product contains less fat, and has historically been less expensive.
But media questions, particularly those from ABC News, drew a stiff response. One reporter questioned whether $150,000 in campaign contributions from BPI to Iowa Governor Terry Branstad influenced his support.
None whatsoever. I will always fight for my constituents, and I will always fight for what's right. And I will never be intimidated by anybody in the press that tries to make those kind of accusations.
Nancy Donnelly, a food safety advocate whose son died after consuming an E. coli-laced hamburger in 1993, staunchly defended BPI's use of ammonia and other safety measures and strongly pushed back against allegations her nonprofit organization is financially influenced by BPI.
BPI has never asked us for a single thing, ever. We will never be compromised in our positions of protecting consumers from pathogens in our food supply. That is our mission, period. My goal is to put my organization out of business, that there are no foodborne illness victims anymore. That is my professed goal. And I will also tell you this, no price can be put on my son's head. I can't be bought, and neither can my organization. We represent the victims.
BPI continues to pay its employees during a self-imposed 60-day shutdown to determine whether or not a public relations turnaround is possible. If not, hundreds of plant workers in multiple states could lose their jobs at the height of the summer grilling season. The Commerce Department reports consumer spending increased in February to a 12-month high, thanks largely to the best 3-month hiring stretch in 2 years. Much of the rise in spending was blamed on soaring gasoline prices. According to the American Automobile Association, the national average price of unleaded is $3.92 per gallon, and prices already exceed $4 per gallon in nearly a dozen states. And that's prompting some presidential candidates to call for increased domestic oil production. But a study released last week revealed little correlation between U.S. oil production and prices at the pump. John Nichols explains.
This is a president who now has an election year conversion. Now he wants to bring gas prices down. Well, the place to start is by firing those 3 people that he hired in the first place. And the place to finish is getting rid of him and putting in place someone who understands what it takes to get energy out of our own ground.
It's the political cure-all for high gasoline prices. Drill here, drill now. But a comprehensive study conducted by the Associated Press reveals increased U.S. oil production has little effect on gas prices. Statistical analysis of 36 years of monthly inflation-adjusted gasoline prices and domestic oil production shows no direct correlation between drilling and the price motorists pay at the pump. And if more domestic oil drilling worked, as some politicians say, unleaded would cost a little more than $2 per gallon. Instead, the national average is nearly $4, a record high for March.
But we've got to drill offshore, and we've got to drill now. Drill now.
According to the Associated Press, campaign promises to lower gasoline prices, be they Republican claims this election cycle or those of Democrats 4 years ago, simply are not supported by hard data. Sometimes gas prices actually rise as American drilling increases. That's what has happened over the past 3 years. Since February 2009, U.S. oil production has grown 15%. But retail gasoline prices also increased from $2.07 per gallon in February of 2009 to $3.58 per gallon in February of 2012. Domestic oil production peaked at about 9.5 million barrels per day in 1970. Production declined significantly in most of the years since, until about 2008, when new and, by some accounts, controversial methods of drilling called hydraulic fracturing unlocked reserves previously thought to be inaccessible. Today, U.S. oil production is about the same as March of 2003, when gasoline cost about $1.69 per gallon. Adjusted for inflation, that gallon of unleaded would cost $2.10 in 2012 dollars. Yet the current national average price in March is nearly $4 per gallon. And that's because oil is a global commodity, and U.S. production has only a tiny influence on supply. Factors far beyond the control of a Congress or a president dictate the price of gasoline. When you put the inflation-adjusted price of gas on the same chart as U.S. oil production, the numbers sometimes go in the same direction, sometimes in opposite directions. If drilling for more oil always resulted in lower gas prices, the lines on the chart would consistently go in opposite directions. Yet AP's statistical measure of correlation found no link between the two.
Since Barack Obama's inauguration, gas prices have doubled. They didn't go down when Obama bowed to Saudi oil princes.
The AP analysis directly contradicts the title of Newt Gingrich's 2008 book, Drill Here, Drill Now, Pay Less, as well as the campaign trail claims of other Republican candidates. GOP frontrunner Mitt Romney also favors expanded drilling and has called on President Obama to lift restrictions in the Gulf of Mexico, the Arctic National Wildlife Refuge, and elsewhere. Yet the late 1980s and 1990s reveal a dramatic disconnect between domestic oil production and gasoline prices. Between 1986 and 1999, domestic oil production plummeted by nearly 1/3, and starting in March of 1986, inflation-adjusted gas prices fell below the $2 per gallon mark and stayed there for most of the rest of the 1980s and 1990s. If the drill now theory was correct, gasoline prices should have soared. Instead, they declined nearly $1. The Associated Press analysis used Energy Department figures for regular unleaded gas prices adjusted for inflation to 2012 dollars. The results were corroborated by public and private statisticians and economists, who added that since the U.S. accounts for little more than 10% of global oil production, there's not much America can do on its own to lower gasoline prices.
The reasons that we've got oil at close to $100 a barrel is because of the saber rattling that the Bush administration's been engaging in with respect to Iran. About 1/3 of that cost is really the spot market saying there may be war.
Candidates often lament high gas prices when it's politically convenient. While he was seeking the Oval Office in 2008, then Senator Obama reminded voters that gasoline had more than doubled since George W. Bush took office. But Obama, who has seen gas prices go up 73% since he took office, now acknowledges the price of gas depends on a lot of factors that are often beyond any president's control.
And that means we could drill every drop of American oil tomorrow, but we'd still have to buy oil from other countries to make up the difference. We'd still have to depend on other countries to meet our energy needs.
The political party of the president doesn't seem to matter much either. Since 1976, the average monthly gas price, adjusted for inflation during Democratic presidencies, has been $2.25 per gallon. Under Republicans, it's been $2.34 per gallon. Obama has the highest monthly average at $3.05, and Bill Clinton the cheapest at $1.68. And when George W. Bush campaigned in 2000, he argued that as an oil executive, he could get oil prices reduced by working with friends in OPEC to increase supplies. Yet it was during the last few months of Bush's term in 2008 that gasoline prices soared to an all-time inflation-adjusted high of $4.27 per gallon. For Market to Market, I'm John Nichols.
Next, the Market to Market Report.
While direct payments to producers appear to be an early casualty, a bipartisan group of farm state senators introduced a shallow loss program this week they're calling the Revenue Loss Assistance and Crop Insurance Enhancement Act of 2012. The legislation would help producers manage increased risk due to downturns in prices or production. Senate Agriculture Committee Chairwoman Debbie Stabenow of Michigan said this week her goal is to have the next farm bill marked up and passed out of committee by the end of April. Of more immediate concern for farmers, however, is the annual rite of spring planting, and an Agriculture Department report this week revealed U.S. farmers intend to plant the most corn acres in 75 years. According to this year's prospective plantings report, corn wins the 2012 acreage battle at 95.9 million acres. The number is slightly above average private estimates of 94.7 million acres, and if realized, would be the most corn acres planted by U.S. farmers since 1937. The report shows soybean acreage falling by 1% over last year to 73.9 million acres. That's 2% below the average trade guess and 5% less than the record year of 2010. While planting numbers appear bearish for corn and bullish for beans, the market reacted more Friday to the grain stocks report and estimates for South American crop production. An already tight old crop corn supply was reduced by 6% from last year, pushing nearby contract limits up. And despite a 10% increase in soybean supplies, bullish acreage estimates and predictions for lower production in South America pushed old crop soybean prices nearly limit up. Friday's post-report rallies were tempered by losses in previous sessions. For the week, May wheat gained 7 cents, while the nearby corn contract moved 3 cents lower. Again, that's for the week. Now, old crop soybeans moved more than 45 cents higher on Friday's reports, but the May contract settled with a weekly gain of 37 cents. And nearby meal prices rallied $15.70 per ton. In the softs, cotton also rallied this week as the May contract advanced $3.89 per hundred. In the dairy market, April Class 3 milk futures gained 8 cents, while the May contract moved 34 cents higher. And in livestock, June fed cattle down $4.95 this week. Feeder cattle were off more than $4.25, and the June lean hog contract declined $1.38. In the currency markets, the euro gained 69 basis points against the dollar. Crude oil declined $3.85 per barrel. COMEX gold advanced $7 per ounce. And the Goldman Sachs Commodity Index lost more than 12 points to settle at 690.85. Well, here now to lend us his insight on these and other trends with regular market analyst Alan Brugler. Well, Alan, everyone's been waiting for this USDA report. It's come out. It was kind of a huge upset to the marketplace. It's still a tale of a very tight old crop and big corn acres for new crop. But wheat was impacted in a big way, and we always start with wheat. So let's talk about your reaction to USDA's numbers as it relates to wheat and the reaction to wheat.
Well, I think the big story in wheat was the spring wheat acreage. The trade was looking for over 13 million acres. We only got 11 million and change. That brought the total wheat acreage down, and so it's a much tighter supply scenario for the next year than what we'd previously thought. It affects the hard red wheat the most. Kansas City and Minneapolis are milling wheat, baking wheat, and that's where the leadership was. But again, we have had a very large speculative short position in wheat, so this bullish news caused a lot of people to head for the exits today. They had to buy their way out, and we had one of the biggest rallies we've had all year in wheat.
All right. Is this a sell opportunity in wheat?
I think you're coming into one. Now, that'll be the million-dollar question for Monday and Tuesday is how much further can we push this thing? But certainly a dynamic reaction today.
All right. But good follow-through on Monday or Tuesday. You look at maybe pulling the trigger.
Yeah, we've still got quite a bit to sell, so particularly new crop. And global supplies are still fairly ample. We're still looking at 10-year highs in projected global ending stocks. So any rally is going to have a tendency to have a short rope.
Where'd those spring wheat acres go?
Well, some of them went to corn, some of them went to soybeans. There's still about 1.5 million to 2 million acres of prevent plant ground from last year that doesn't really seem to show up in the U.S. acreage table today. Probably producers weren't sure if they could get it back into condition to farm it this year. So there's still potential to get a little more acreage if this rally continues to draw some more spring wheat acreage in. But again, most of it shifted to corn and soybeans. Corn, for example, we're looking at record corn acreage for North Dakota, South Dakota, Minnesota, and Idaho, and across that whole northern tier where most of the spring wheat's grown.
Absolutely, and there has been a huge shift in corn, and also Wisconsin too. So a lot of corn definitely is going to be out there. The acreage number, the acreage intentions was a big number, 95.9 million acres, but that really wasn't what this rally was about, was it? It was more about stocks and declining stocks for old crop corn to hair trigger tight levels.
Yeah, we were very tight to begin with. The forecast in May was 801 million bushel ending stocks. Then we missed by 200 million bushels or so on the trade estimates for today. The USDA was
Which
just
is huge when you're talking, what, 810 to 575?
Right. Yeah, it's a big undershoot. And in fact, a couple days ago, the trend had been that the USDA is going to show a really big stocks number, maybe even bigger than the average trade guess. So caught everybody leaning the wrong way, and so you got a limit up move in the nearby May. The corn number for the new crop, the planted acreage number, is actually fairly bearish. But if you're running out of old crop, you're going to tend to pull the whole pile of contracts up. In some ways, it's reminiscent of 1995-96, which was the year when we had the most similar stocks usage ratio. In that year, the July really took off against the December new crop contract right after the March report. And that's kind of, today at least, the script we were following.
All right, and of course we can still have some shifting. Again, those are intentions on the acreage, but the stocks number. A lot of analysts we talked to were talking maybe we'd be back over 1 billion bushels carryout. We're at 575. That's almost a 400 million bushel swing. What was the explanation for that?
Well, again, it's the shortfall in the March 1 stocks projected forward for the last half of the year. And we only basically have the usage numbers for the first half. But if you analyze the numbers, clearly the feed and residual use was higher than what the trade was expecting, and the ethanol held up its end. Exports at the time the survey was taken were keeping up with a year ago. So everything was still hitting on all cylinders.
All right, Alan, we need to move on, but corn sales. A lot of people are still holding old crop. Is this going to be a wild deal in July and August? Then do you think should we hold on here? Should we take advantage of this move?
I think you have to be patient with at least the last 20% or so of your production. It's okay to reward the rally if you're behind on sales, but we think you need to keep those gambling stocks because this, using 95-96 as an example, it could get pretty woolly out there.
All right, 95.9 million corn acres. Should I be selling some new crop?
Again, you probably want to reward the rally. Depends on where you're at already. A lot of producers have already made some sales earlier for fall delivery. We're basically 20-25% sold with a few hedges around that.
So if you're not there, you may want to step up there, particularly if we get followed through on Monday and Tuesday. We got to switch to soybeans, and again, that may be the most bullish story out there now.
Definitely. We got a slight bullish surprise on the old crop stocks.
Right.
We got a very big bullish surprise on the acreage at 73.9 million acres. The trade was comfortable that corn was getting more acres, but soybeans would still hold all of theirs. The juice would come from elsewhere. It turns out the bean acreage intentions are down. And of course, South American production has dropped fairly dramatically. Private estimates are another 300 million bushels smaller than the most recent USDA number. So the world needs more beans. At the moment, they're not going to get them from the United States, so the market's trying to fix that before we get too far into planting.
Hey, maybe we'll see some shift in acres. What about bean sales? Want to hold off for the time being, see how this thing plays out?
We've been fairly bullish on beans, even going back to December. We've made very minor sales of cash soybeans. Probably don't want to ride that horse too long on the old crop sales because, again, South America does have beans to ship.
Right.
It's just they're going to run out a lot quicker in the fall, and that has big impact for new crop.
Sell 14 on the board, November?
Well, we think you get a little better now on old crop particularly.
Okay. All right. Real quick on cotton. It was an up week for cotton. There's some acreage down there. What's your outlook real quick on cotton?
Basically, acreage intentions were about as expected. We didn't really get much market reaction in cotton today. We've got plenty of old crop stocks to carry us there.
All right. Not near the tightness. Let's switch to livestock because it's a terrible week on the board as far as the livestock markets are concerned. We see a lot of pressure now and then this cash market as well. Obviously, this discussion about the finely textured beef product is having an impact. Where are we headed? We get through this. Fundamentals are still good?
Fundamentals have actually deteriorated a little bit. I don't blame the whole break on the textured beef. I think the problem is that we've got carcass weights are built up. We're about 25 pounds a head versus a year ago, heavier. So we're putting out more beef. We're getting into some bigger cattle numbers from all the cattle that were placed last summer off of the Southern Plains drought. Those are all starting to come out of the feedlots. And basically, when we get the wholesale prices up in the $190 range per 100 pounds, we have a hard time selling it to consumers. So we've got a demand problem, we've got a supply problem, the board's reflecting that.
All right. But the closeouts have looked pretty good on gains on these cattle this winter, too.
Yeah, with phenomenal performance. But again, that's become a problem because we're getting the cattle sooner and they're heavier.
Calf market was under pressure, too. What's your take there?
margins are deteriorating, and whenever you've got the cattle dropping and the corn going up, that's a bad combination for feeder prices. It's great if you're buying the feeders for the feedlot, but it's not so good if you're selling them.
Absolutely. And let's talk hogs. What you see ahead on this pork market, we've become so export dependent. I think there's almost a fourth of our hogs now are exported. Is that market going to stay strong, or we hear about this slowing in Asia? What's your take?
Well, we are very export dependent, and when the exports slow down as they did here in February and March, we see it on the cutout values, and that's what we're experiencing right now. Now, typically the cutout starts to turn higher as we get into April and May because of domestic demand and because we slow down the hog slaughter as we get into summer. So I think we've got a little window here where we're still under pressure, but things should start to firm up.
We got a break on crude oil, Alan, this week, a positive one. Hopefully good news for gas prices here soon. As you look at crude oil going forward, it looks like domestic supplies are adequate. Where do you see this price going?
Well, again, the problem is your gasoline and your diesel are priced off of the Brent crude, the international crude. Our domestic crude has come down, as you point out, the West Texas Intermediate. The international is much more dependent on what happens for the Middle East. And what happens with the U.S. dollar. So, I think we can get a little bit of a pullback on the crude. The problem with the gasoline and the diesel, though, is that we've been shutting down refineries. There's another one here in the Midwest that's going to be taking downtime for most of the summer. So they're tightening up the physical supply of the commodity.
So there's plenty of crude, but it's a refining issue.
Yes.
Do you think we'll hover in this $100 range?
I think there's a good chance we can hold that, or at least above 96, 97.
All right. I always watch gold to kind of see the pressure on commodities. We're up just a hair this week. Your take on gold in 5 seconds.
Well, don't buy any more, but you don't have to sell what you have.
All right. I like that reaction. I think that's about as good a way to put gold as you can. Alan Brugler, thank you very much. As usual, that'll wrap up this edition of Market to Market. But if you'd like more information from Alan on where these volatile markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, streaming video of our program, and links to our Twitter feed and Facebook page. And it's all free at the Market to Market website. And of course, be sure to join us again next week. We'll visit an auction that was billed as the end of an era. So until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.